Hey traders, Clifford back with another video on trading the charts. So in the last video we learned about support and resistance and how that can benefit you in your trading. In today's video we're going to learn about a very important tool in trading called the Fibonacci Retracement tool and how it can benefit you tremendously in your trading. So with that being said, let's get started. Okay, Fibonacci. Well, if you could Google this, but basically he was a 13th century Italian mathematician that discovered that all things in nature have a numerical sequence. And this applies to trading as well. Basically, there are levels in the market that his numerical sequence applies to, and they are very significant levels. Also, it is based on a theory that if a market moves in one direction, a large move, the theory is that Fibonacci will actually retrace at least 50% of the last move. So, but what does all this mean to us? So basically, as traders, what you want to do first is pull up a daily chart, right? I mean, I only use the daily charts, but you could use whatever time frame you want. I highly recommend daily. So basically what you're looking for is a 1-year high and a 1-year low. This is, again, daily chart shows us a full year. So let's put up the 1-year high and the 1-year low. And if you can't see it on the chart, I'll show you right now. Here and here. This is the euro, by the way. So 1-year high up here, 1-year low down here. And the way you get the Fibonacci numbers is basically you add the two together and divide it by 2, and that's 50% of the last move. So you see how this market made this huge move to the downside, and look what happened. It retraced 50% of the move right here. So basically what you do is you pull up this tool here called the Fibonacci Retracement on TradingView or whatever trading platform you're using, and then you draw from the high down to the low. And there you go. There's the tool. So, but what is this we're actually looking at? Well, basically, these are the levels. It starts at 1 and it goes to 100, which is the entire move. So anywhere from 1 to 100 is basically the full move. And there's different levels. There's a 23% level, there's a 38% level, there's a 50% level, a 61% level, and a 78% level. In my opinion, the 50% level is the most important. So you see how when the market hit this high and hit this low, Fibonacci states that markets retrace part of the move, normally 50%. Well, look what happened. As it started to come back up, boom, 50% level right here. And not only did it touch that level, actually when it gets close to the 50% level, 3 things can happen. It could pause, it could smash right through, or it could completely reverse direction. So, but how would you use this in your trading? Well, basically, if a market closes above the 50% level, you want to be a buyer because that's a bullish signal, like right here. And it would have worked out pretty good, as you see, like, or if you bought down here, a good target is the 50% level because that markets normally retrace 50% of the last big move. So that's how you would use that. But it applies to all markets. I mean, we could look at another market here. Like, let me pull up one. Here's one, Bitcoin, right? Okay, so here's Bitcoin. Same thing. Get your high for the year, get your low for the year. And I got it here, and I got it here. And then we'll put on our Fibonacci tool, which is here. So there you go. So here's the tool again. And basically, here's the low for the year, here's the high for the year. So what happened? Well, basically, when the market hit this high, it's most likely going to retrace 50% of the last move, which is here. And look what happened. As it approached that level, there's a lot of volatility at this 50% level. And look what happened. The market completely rejected the level. So that's why I'm saying that could be a great place to take profits if you're short or if you're selling the market, because when it approaches the 50% level, things are going to happen. Either it's going to pause, it's going to break through, or it's going to reverse. Look what happened. It reversed. But then eventually it came back down and it broke through the 50% level, which is a bearish sign. So now you could re-enter selling positions again. because it is now below the 50% level. Traders are constantly watching these levels, and these levels too, 23%, 38%, pretty much they're all significant, but the 50% is the most significant in my opinion. Here's another example. So like here is the oil market, right? And this is like live. This is like right now live oil, right? So again, get your 1 year high. Sorry, one year high is here, $76. 1 year low is here, $34. And then what do? We put up our tool, boom, right? And what do we got? Well, basically right now we're sitting at $70. But if the market does enter a downtrend and it breaks below this trend line, and it sells below the support here, there's a possibility it could retrace to where? $55, 50% of the last big move, from the low to the high, 50% level here. So what would you do, like if you're selling the oil market in the future because you see it breaks below support, which is a bearish sign? You could watch for activity here, like at the 78% level. You see it start rejecting this level. You could re-enter sell positions. You watch for the 61% level, and you see it rejects those levels on pullbacks. You could re-enter more sell positions. Breaks below the 50% level, re-enter more. Here's a trade that I recently did in the euro. Actually, I'll just pull it up real quick here. So why did I take this trade, right? Well, the reason I took this trade is so the euro had entered a bear market a few weeks ago or a month ago, whatever. Like here was the top 1, 2, 3 top. If you don't know how to find top formations, in my next video we'll talk more about chart formations. But this is just a basic video about Fibonacci. So basically, a lot of people sold the euro here, and I missed this move, this big move down, bam, bam, bam. But I was like, where can I enter this market and sell and still make a profit? Well, that's where Fibonacci comes in, because I saw that when it hit this level here, see this 23% level? Look, it rejected it. And then, of course, I'm watching for the 50% level. And I saw here, rejected the 50% level right here, rejected it again, weakened again. So I'm like, okay, you know what? I'm going to take a short position right here because it's rejected the 50% level 3 times, and I think it's safe to enter short, which I did. And now I'm in profit. So that was a good trade. And that's how it can help you. Same thing here. This was last night, actually. I was watching this one too. This is the dollar Swiss. And here's the low for the year. Here's the high for the year. And here's the 50% level. And look what happened. It broke through the level recently and was building some momentum. The dollar's been strengthening, but just yesterday it rejected this 50% level. So you know what? I'm like, I'm going to buy it now because I see a rejection of a very significant level, and let's see what happens. And so far the trade has not hit my stop, which is behind that level. So that's kind of like a basic understanding of Fibonacci. Another way you can use it is, let's see, let's try another market here. I haven't tried this one yet, gold. So let's pull up gold and see what we got. So here's gold, right? Here is the low for the year, here. Here's the high for the year. Look what happened, retraced 50%. So if you were selling gold down here, you could probably anticipate that it's going to make it to the 50% level, because the theory in Fibonacci is it normally retraces 50% of the last big move. But then what happened? Well, we had some rejection of the level again here, rejection of the level again here, and now we can put on the other levels so I can show you that the others are significant too. Real quick here, let's go to the other levels, put them all up here. So now we got, here's the 1 point, right? Starts at 0 all the way up to 100. And then you got your levels, 78%, 61.8%, 50%, 38%, 23%. Well, look what happened. It did break below the 50% level, which was bearish. So I probably would have sold here. But then, markets, sometimes they change direction, and this one did. Once you see it's not, going in your favor, and you see it starts rejecting, like here it's rejecting the 38% level and it's moving higher, this is a sign that market direction could change. So as you see now, it broke above the 50% level, right? Here it closed above it, and look, it rejected the level to the upside. So now you can be a buyer because it broke above that level. And this applies to stocks too. It doesn't matter what you're trading: stocks, forex, crypto. Let me see if there's one more here. Maybe Dogecoin. Here's one. Yeah, here's one I was watching. So like here's the low of the move, here's the high of the move. And look what happened. It made it to the 50% retracement and it rejected that level. And now it's been in a downtrend actually. And look, here's the 23% level. It closed below it, but it hasn't gotten back above the 38% level, which is a bearish sign. And if we go back to Bitcoin real quick, I was watching this one the other day, and look, it's still struggling to get above, which one was it? Oh, 38%. See that? 38% right there. See how Bitcoin, it can't break above the 38% level. It's struggling. And now it's even struggling more. Look at this, 23% level Fibonacci. It can't even break above that. So definitely Bitcoin is as weak as it can possibly be right now. So that's basically about it for this video. Just a basic understanding of Fibonacci and how it can benefit you in your trading. Definitely, I highly recommend pulling up some of your charts and trying to play with this tool, because you'll see it really does have a lot of significance in your trading. And the bottom line is, if you see it's approaching a 50%, a Fibonacci level, and you're a buyer, you want to kind of like watch those levels. If you're a seller, you also want to watch those levels because they're very, very significant. And traders all over the world and banks and financial institutions all over the world, in my opinion, are watching them. So that's about it for this video. If you like this video, feel free to like, subscribe, put your comments below. Also, you could check me out on YouTube and Twitter. And in the next video, we're going to talk about one of my favorite things in trading called chart patterns. So definitely be on the lookout for that. And once again, my friends, trade what you see on the charts. Don't necessarily, pay attention to the news as much as the charts. News is important, but charts are even more important. And trade well, my friend.